In this video, we're going to talk about a trading strategy called the Bollinger Band squeeze. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this is the Bollinger Band squeeze strategy, not to be confused with another kind of well-known squeeze strategy from a bit more of a well-known trader out there. That's a different strategy, although it's similar in terms of the criteria, but this is just purely based on Bollinger Bands. Right, theory of the theory of the setup is Bollinger Bands have been expanded and they now contract, and as we know, it kind of gives us an idea of volatility. When Bollinger Bands are contracting, price is just stagnating, shopping around, not doing much, not much volatility, standard deviations quite narrow. And then what we're looking for is price to explode out of those narrow bands, Bollinger Bands to then expand, and we're looking to try and trade in the direction of that momentum. Now, I had a look through again some of these charts, and there weren't that many examples of a good squeeze setup on a daily chart. There weren't that many examples. I looked at some stocks, I looked at the currency pairs. I couldn't find that many good examples, and I got to thinking, well, you don't really get that much of a contraction in Bollinger Bands on the bigger stuff, do you? I mean, you do get periods with low volatility. A euro US dollar will go into a low range or down a low range DAX, and the Bollinger Bands may contract over time, but you don't really get that real change of momentum that you need for this kind of criteria to set. The whole point is it goes from very, very low to very, very high. So I got thinking, okay, let's have a look on a 5-minute chart, and thinking, I know I've seen volatility expand from kind of a couple of pips range to 10-20 times that, and yeah, lo and behold, you do get it quite often on charts. I've got a 5-minute chart here, happens to be the DAX. It could be anything. We'll bring up something in a second. Theory is we've had a wide Bollinger Band here. They've narrowed down, narrowing down, and you can see the difference between kind of there and there compared to there and there. We're in the kind of zone that, if it breaks out now, we want to be involved in it. As far as this criteria goes for this trade setup. Now, criteria 1, Bollinger Bands must be tight. Criteria 2, price must close above or start breaking above the upper Bollinger if you're going long, or breaking below the lower Bollinger if you're going short. So we get it here, it fires off here. Now, stops and targets vague, but if you think about this, the whole point is it's a momentum expansion. So really, you're probably going to have your stop just under that center point of the Bollinger Band. It makes sense. If it's a genuine breakout, volatility expansion, momentum play, you don't want to be putting your stop way below under lows, because as soon as that thing comes back below the kind of midpoint of what you're using as a reference, i.e. the midpoint of the Bollinger Band, the trade's negated anyway, right? You don't want to be involved in it. So that would be my guide for a stop if I was taking this trade. Targets, I like to use a fresh target for each trade. On here you can see straight away you coming in at, what time is it, 9:15, so you're after the hours, but you know that US session closes in 45 minutes, and this is UK time, by the way. I would probably be saying, hey, you know what, let me see what happens at the close, see where we close, see if we get some follow through, or perhaps you're looking for that 13,000 whole number, whatever. I think targets, you can be mechanical with your targets, of course, and I'm really an advocate of doing that if you want to scale some, but I really also am an advocate of saying, hey, you know what, if you're right, let the market pay you for being right. So by all means, start to scale off some of your risk plus a bit to pay for the trade, and kind of put some in the bank, so to speak. Maybe scale some off at the close in this example, but in reality you want to hold some for more follow through, because that's when you get your many multiples of your risk, and that's when you get paid, and that's when your account really does grow. So in this example, we're long here, and whatever your target may be, if you've got a trailing stop, perhaps you're going to end up coming out here, because you're not going to get the very top. Let's be honest, you might end up coming out the next morning at the open. If you're at the open, then you're going to be out here. At the close, you're going to be out here. A trailing stop, you're going to be out here. If you had a lower Bollinger test again, you're going to be out here. Whatever the point is, it's not a bad trading strategy. Let's have a look and see if we can find another one with another market. Here's one here on the US dollar yen, guys. This is an interesting one because it's real world stuff, but it's all right, you know. Bollinger Bands go tight on a 5-minute chart again. I think this is kind of the sweet spot for it. Maybe comments below if you think there's a better time frame for this one, possibly hourly, 4 hourly. But let's go to the 5-minute for now. Anyway, point is in this example, you're starting to go long here. You're going to get pinged out once on this already because the Bollinger Bands have gone narrow. You've gone long here and you've taken a stop, or whatever it may be. If we're using that mean that I kind of alluded to earlier, you're taking a little bit of a stop there. But then, you know, you maybe go again, you maybe get stopped out again, you're kind of maybe frustrated by it. But this is where this trade comes into its own. I think by the nature of the trade setup strategy, you should expect to have a few ping outs before you get hold of a real juicy one. Then you get the breakout here, you take it, and now things start to go your way. Where's the thing? Now, obviously, if you're going to use that mean there, you're going to get stopped out on that, given that's fine. But if you're kind of saying to yourself, all right, let's use a stop a bit more sensibly placed, or, you know, I consider that as still a bull flag, it's holding at highs. You've got to put things in perspective, guys. The point is, if you go back to this part here, we've gone up, come straight back down again. That's very fair to have a stop loss there. Here you've gone up and you've held at highs, and the mean has caught up with it. Maybe you've come out in terms of a time frame, but you probably want to be in it. But the point is, look at if you get on the end of a volatility expansion, momentum expansion trade. You say, okay, I'm in here, I'll risk below here, or I'll risk whatever, because ultimately, let's look at the number of pips, guys. You're talking 29. It's not even a 10 pip risk on it. So you're not going to be risking 3 or 4 pips. You're going to be saying, okay, let me go the low of that. I may as well risk at least, you know, 10 pips on the thing. And even that's bringing you down to here. You could risk less. But the point is, look at the reward you're getting for getting on the end of momentum. Now, I know that you're aware when you get on the end of momentum, you get on the end of volatility expansion, the thing goes. That's the key to this strategy, I think, is that the contraction is going to indicate quiet periods. You're going to get a lot of false moves. You're going to get pinged, 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 stopped, stopped, stopped. But when you get on one, like this, for example, whatever rules you're using, that indicates, you know, there's a precursor for a breakout. All of a sudden you've got 80, 90, 100 pips in the bag, making it a nice day trade for you. So something to consider. I think there might be a better way of getting, I think maybe another filter on top. I don't think my kind of off the cuff stop placement is that good. I think you might have to adjust it depending on where you are. You kind of have to have a minimum of 10 pips if you're scalping it. But anyway, let me know your thoughts in the comments below. How would you adjust this strategy to suit? This is the squeeze strategy. It's not the traditional squeeze that you might have heard of from other well-known trader out there, but it's the same kind of thing. Volatility contracts, volatility expands. Which way it goes is the way you want to follow. Anyway, guys, take care. Good trading. See you in the next one. Bye-bye.